Hi everyone, my name is Agni Chowdhury. I'm an SMSF Specialist Advisor, and today the topic of the webinar is, can an SMSF conduct a business? The question of whether an SMSF can conduct a business is an intriguing one. Recently, the ATO has raised concern that an SMSF carrying on a business may be in contravention of certain rules. In this presentation, we will examine whether an SMSF can carry on a business. Specifically, we will review the provisions of the SIS Act, the SIS regulations, and the tax acts that must be considered when an SMSF carries on a business. We will also look at the provisions in the context of some typical businesses, such as property development and share trading. And by the way, I have uploaded handouts so you can download and refer to it. So, what is a business? By business, we refer to the common law definition of a business. Here, I will not elaborate too much on this slide. This is deemed to be assumed knowledge, and the slide only serves to refresh our knowledge. For example, there is no one factor that is decisive of whether a particular activity constitutes a business. Profit motive, size and scale of business, planning and organization, continuity and repetition, and commercial purpose of character are all relevant factors in determining whether it is a business or not. Property development may indeed constitute a business when there is a substantial pattern of buying and selling that is more than a mere realization of an asset. Say, for instance, where an existing property is subdivided by an SMSF into 4 apartments and sold. This may not be a business. However, where an SMSF has a large parcel of land and goes about subdividing and developing many homes and then selling them off quickly, this may constitute a business, as there is considered to be a substantial pattern of buying and selling. Which then brings us to the important question: can an SMSF conduct a business? Now here's the thing. The ATO has confirmed that there is nothing expressly prohibiting SMSFs from conducting a business. Rather, the question is whether such activities cause the SMSF to breach the provisions of the SIS Act or the SIS regulations or adverse tax consequences under ITAA 97. There is a common misconception that superfunds cannot carry on businesses. There is no provision in the SIS Act or the SIS regulations that expressly prevent an SMSF from operating a business or tax income derived from a business in a manner different from other passive investment incomes. The ATO has confirmed this view in a number of non-binding publications over the years, including the National Tax Liaison Group NTLG Superannuation Subcommittee meetings on 26th of October 2005 and its publication titled Carrying on a Business in a Self-Managed Superannuation Fund. Essentially, in these publications, the ATO's view is that while running a business does not cause an SMSF to breach the SIS Act, rather, the activities of the business may cause the SMSF to breach one of the SIS rules. So, can an SMSF conduct a business? Yes. Most commonly, an SMSF invests in an entity that carries on a business. Some common structures through which an SMSF can carry on a business are the pre-99 unit trust, the Regulation 1322C unit trust, otherwise known as the ungeared unit trust, the unrelated unit trust or the geared unit trust, or private proprietary limited companies. Now, it is beyond the scope of this discussion to talk about all these structures. If you are interested to know more about these structures, perhaps you should attend one of our seminars. I've provided the link on the slide, and you can hear our experts who will take you through the pros and cons of investing through each of these structures. So what are the relevant considerations in conducting a business through an SMSF? Here are some of the most important issues you should consider. The trustee, the investment strategy, the sole purpose test, the arm's length rules, the in-house asset rules, the prohibition against providing financial assistance to members, the borrowing and related issues, the trustee remuneration, and the tax considerations. We will briefly look at each of them. The trustee is the starting point of this discussion. Essentially, a superannuation fund is a trust fund and is bound by the ordinary principles of trust law. It is a well-established principle of trust law that a trustee cannot carry on a business unless expressly authorized to do so by the trust instrument or by statute. A case in point is the Kirkman versus Booth case. Since the statute is silent on this matter, the trustee at the very least should not prohibit such an act. Closely related to the trustee is the investment strategy. Under Section 52B of the SIS Act, the trustees must prepare and regularly review the investment strategy. Although it would be prudent for an SMSF trustee undertaking a business such as property development to include this in its investment strategy, the investment strategy requirements do not expressly require it to be accurate or for it to be followed. However, the investment strategy rules do provide a safe harbor for superfund trustees that prevent members from taking actions against them for poor returns, provided the investment is undertaken in accordance with the superfund's investment strategy. The overarching issue that is really the acid test for the ATO in carrying on a business within an SMSF is the sole purpose test, and this is what we will discuss next. Now, Section 62 of the SIS Act provides that super funds must be maintained for the purpose of providing for retirement benefits, to put it very simply. A common misconception with the operation of the sole purpose test is that a risky or unusual investment will cause a super fund to breach the sole purpose test. In reality, what the test is about is whether a super fund's activities result in the members or the related parties of the members from receiving pre-retirement benefits. Or to put it another way, do the activities result in money being taken out of or deprived from the super fund? This has been confirmed in the way the sole purpose test has been applied by the courts and interpreted by the ATO. SMSF ruling 2008/2 lists some factors that would weigh in favor of a conclusion that an SMSF is being maintained in accordance with Section 62. They are, firstly, the benefit is an inherent or unavoidable part of other activities. Secondly, the benefit is remote or isolated or is insignificant. And finally, the benefit is provided by the SMSF on arm's length commercial terms. Example is when the benefit is provided at market value. Examples of where the sole purpose test may be breached in a superfund context is where the superfund employs related parties for more than market consideration. For example, a related party builder is paid excessive building fees or profit share arrangements, or related parties are employed and received inflated salaries. In a property development business, an SMSF should therefore not become an extension of the property developer's business activities. The SMSF must therefore make prudential investments associated with providing retirement benefits. Also, the SMSF should not be undertaking activities that merely enhance the member or related party interests. Now let's go through an example of a recent case that violated Section 62 of the SIS Act. In the Deputy Commissioner of Taxation versus the Lyons case, Mr. Lyons, as a trustee of the SMSF, made back-to-back loans to assist his ailing business. In that case, the court declared that Mr. Lyons contravened Section 62 by failing to ensure that the fund was maintained solely for one or more purposes as set out in Section 62. Instead, maintaining that the fund was maintained for the purpose or significant purpose of making back-to-back loans to provide working capital for Mr. Lyons' retail business. Similar to another case, the Deputy Commissioner of Taxation versus the Graham family superannuation case, the court also declared that the fund contravened, in addition, Section 65, the prohibition against providing financial assistance to members, which we'll discuss in a while, Section 84, the in-house assets, and Section 109, the arm's length rules, which we'll discuss next. Hand in hand with the sole purpose test is Section 109 of the SIS Act, which requires SMSF trustees to deal with related parties on an arm's length basis, or if the dealings are not on arm's length basis, does not favor the related party. Together with the sole purpose test, Section 109 is primarily aimed at preventing members being taken out of the super fund. An instance of Section 109 breach may occur when SMSF trustees pay a related party an inflated price for services rendered, for example, building services, or transferring shares to an SMSF at less than market value, especially when a large portfolio of shares are maintained to avail of large imputation credit refunds or reduce CGT gains, for example, when an SMSF is in pension phase. Thus, SMSF must avoid any contraventions and document transactions with related parties that evidence arm's length terms. For example, to obtain quotes from third parties and possibly gather suitable evidence. Failure to keep related party transactions at arm's length can give rise not just to superannuation legislation compliance issues, but also to tax issues, for example, excess contributions and non-arm's length income. Another important issue is acquiring assets from related parties. Now, Section 66 of the SIS Act prevents an SMSF trustee from acquiring an asset from a related party unless one of the exemptions apply. Relevantly for property development business purposes, one of those exemptions is business real property. This means that a member can contribute or sell their business real property to the super fund without breaching Section 66 and allow the super fund to potentially develop the property. Business real property is defined as certain interest in real property, where the real property is used wholly and exclusively in one or more businesses. An important part of the definition is that the land must be used wholly and exclusively in one or more businesses. This would generally rule out residential property unless the owner of the land is carrying on a rental business or is a property developer and the land is held as trading stock. There is legislative concession for farmland meeting the definition of business real property, which allows farmland to still be classed as business real property, even if up to 2 hectares of the land is used as a residence, provided the predominant use of the property is not private or domestic. The ATO's views on what comprises business real property is set out in its extensive ruling SMSF R 2009/1. Examples of business real property include your classic retail, commercial, industrial, and farmland, a residential property used as a retail or commercial premises, for example, a doctor's surgery clinic, a residential property used by the owner in a rental business, leasehold interest in business real property, vacant land if it is used in a business, for example, a car park, and land held by a property developer for the property developer's business. Next are the in-house asset rules. The in-house asset rules are a topic unto itself. We will briefly touch upon it to explain its relevance in the context of a property development business. The in-house asset rules prevent an SMSF holding an investment in a related party or a related trust and making loans to related parties if the combined value of those assets exceed 5% of the total value of the assets of the SMSF. In a property development business context, the in-house asset rules will be relevant in relation to investing in trusts and companies that will develop property or where loans are made to related party developers or builders. When considering the in-house asset rules, it is important to determine who is a related party of the related trust. The rules are contained in Part 8 of the SIS Act. In particular, that part contains the provisions of working out who is a Part 8 associate. The rules are very complicated, and therefore the following is a simplified overview of these rules. When considering the application of the in-house asset rules, the particular provisions of the SIS Act should be carefully reviewed. In simple terms, a Part 8 associate will include the relatives and related companies and trusts of the members of the SMSF and the SMSF standard employer sponsor, if any. When considering whether someone is a related party or a related trust of the members of the SMSF, the standard employer sponsor and the related parties of the members and the standard employer sponsor are all grouped together. A company will be a related party when the group controls the company under either of the following control tests. A. The group has sufficient influence or control over the board of the company. Or B. The group controls more than 50% of the voting rights in the company. A trust will be a related party where the group controls the trust under any of the following control tests. The group controls the trustees or the board of the corporate trustee, whether directly or indirectly, formally or informally. The group has entitlements to income or capital of the trust that exceed 50%. Now note that 50% is okay, so it should be above 50%. Or the group has the power to remove the trustee of the trust. Possibly a less important factor, Section 65 of the SIS Act prevents an SMSF trustee from providing financial assistance to members or relatives of members. This prohibition will generally have limited application in a property development scenario, but it could be applicable if the SMSF trustees made a loan to a member or sold a development asset to the members on favorable terms. It could also apply if the member is employed by the SMSF as a builder and paid in an advantageous manner. For example, paid for the full price upfront when the standard practice is to be paid in stages. Borrowing and related issues. Now, under Section 67 of the SIS Act, SMSF trustees are prohibited against borrowing unless an exception applies. The most significant exception is the ability to enter into a limited recourse borrowing arrangement, commonly known as an LRBA, under Section 67A and 67B of the SIS Act. Importantly, if an LRBA is structured incorrectly or ceases to be structured incorrectly, then an exemption will no longer apply and the borrowing will cause the SMSF trustee to breach Section 67 of the SIS Act. Another issue that might arise is that superfund trustees must not give a charge over an asset of the fund under 13.14 of the SIS regulations. Charge includes a mortgage, a lien, or any other encumbrance. This is an important consideration to take into account where an SMSF trustee undertakes property development. For example, it is common in non-SMSF property developments that a developer will require a mortgage over the land or a guarantee from the landowner in support of the developer's loan from a bank to finance the development. SMSF must therefore carefully inspect each relevant document, especially standard building contracts, and exclude any mortgage, lien, or other encumbrance. It is also important that the SMSF trustee doesn't inadvertently breach this provision in its contractual documentation. For example, the development agreement can contain a contractual term which is an encumbrance, as it prevents the SMSF trustee from dealing with the land. Now to another important topic, the trustee remuneration. Section 17A of the SIS Act provides that a fund will not be an SMSF if the trustee or the director of the corporate trustee of the fund receives any remuneration from the fund or from any other person for any duties or services performed by the trustee or the director in relation to the fund. This is a very serious requirement, as a breach of this provision will cause the SMSF to become non-compliant, and further, there is no discretion to the ATO to treat it otherwise. This raises the question as to whether trustees, directors can be paid for performing some or all of the development services in a property development business, for example, for the SMSF. Such activities will not be caught by Section 17A if the provisions of Section 17B are complied with. Section 17B provisions include A. The trustee director performs the service other than in the capacity of the trustee director, and the trustee director is appropriately qualified and holds all necessary licenses to perform that service, and the trustee director performs the duties or services in the ordinary course of a business carried on by the trustee director of performing similar duties or services for the general public, and the trustee remuneration is paid as an arm's length transaction. So, essence then is suitable qualification for the trustees in a particular trade. One such example is that of a trustee who's a plumber and is being paid by the SMSF the same fees as is charged to the general public for that kind of a job. Now, tax considerations is very, very important. Section 295-85 ITAA 97 is the starting point when considering tax for businesses such as share trading or property development in an SMSF. From 10th May 2011, an SMSF cannot use the trading stock exemption to account for gains and losses on certain assets on revenue. What this means is that shares in a company, units in a unit trust, land, and even land bought with the intention of selling at a profit will be held on capital account. Let's consider, for example, the Chow Super Fund that co-invested in a vacant block of land with unrelated parties. In the 5 years since the group bought the land for $500,000, 5 residential units were built on it and are to be sold this income year for $400,000 each. Although the SMSF and the related co-investors will undertake related transactions, the gain on the sale of the units by the Chow Super Fund will be taxed under the CGT provisions, whereas the other investors will be assessed under the revenue account under Section 65 ITAA 97. Briefly, I'd also like to touch upon the Nollie Provisions, which is again a very important consideration in this context. The non-arm's length income rules tax certain types of income at the top marginal tax rate. Now, it is beyond the scope of this presentation to go through the Nollie provisions in detail. However, briefly, they will catch income derived as a result of non-arm's length dealings, private company dividends that are derived as a result of non-arm's length dealings, distributions from non-fixed trust such as discretionary trust, and distributions from fixed trust where the fixed trust income was derived from non-arm's length dealings. In a property development context, the non-arm's length rules will generally be avoided if all the dealings with related parties are undertaken on an arm's length or a commercial basis. Well, that brings us to the end of the webinar. I hope you really enjoyed it, and if there are any questions, please email them to me at agni@trustee.com.au. I will try and answer them as soon as possible. So once again, a big thank you to all attendees and hope to engage with you in the next webinar. By the way, we will email you details of the next webinar very soon. So bye for now and enjoy the rest of your day. Cheers.